Shares of Disney jumping in after hours trading about 5.5% there, and that's after reporting better than expected third quarter earnings. Well, joining us now is Ivan Feinseth, Tigress Financial Partners Chief Investment Officer. So what was most impressive to you out of what we saw with Disney's earnings, Ivan?
Well, I've been saying this all along, that content is king and Disney is the king of content. And it's Disney's incredible content that drives everything. It drives park visits. It drives toy light sales. It drives streaming subscriptions. So 7 of the top 10 world's highest grossing movies are Disney. And it only changed recently because Top Gun has done so well, it made it into the top 10. So Disney has incredible content. They have the ability to produce incredible content, and they dominate the highest grossing genre in movies and television, the action adventure movies. So, for example, the success of Obi-Wan has driven Disney Plus subscribers, probably in the most recent quarter. They have another feature coming out with Andor, another Star Wars character. And the more you dig into finding out about these characters, the more people subscribe and increase their viewership in other related shows. So it is all about content. So I am impressed with the results. I am not surprised by the results because it's driven by the power of their content.
Ivan, it's been a pretty volatile quarter, right? Netflix losing 1 million subscribers, Peacock adding no subscribers. Then we have Disney adding well over 14 million subscribers. So considering all of these companies, all of these results, what should investors take away when it comes to the current state of the streaming wars?
It's all about content. It's people subscribe to these services. And Netflix has great content too. And everybody has favorite shows that they like on Netflix and favorite shows that they like on these other services as well. But as far as consistency and the value of their content franchises, Disney is just head and shoulders above everybody. And this will continue to drive their streaming subscription growth. I said from the beginning when they launched Disney Plus that one day Disney would out Netflix, and they have. And that will only continue, again, driven by the power of their content. Consumers want to travel and they want to go to Disney parks because everybody has a favorite part of the park and favorite content and characters that they like that drives park visits. Everybody has characters and that they like that drives toy sales and product licensing. So Disney's flywheel is driven by this content, this incredible content that drives this flywheel of revenue that includes park visits, movie ticket sales, toy licensing, and everything they do. Even the ships, they have cruises. They just launched another cruise ship this summer, and it has a Star Wars themed bar. It has all kinds of Disney characters and themed parts of the ship, and that engages people to want to go on the Disney cruises. So it's the power of the content that drives this incredible flywheel.
So you seem pretty bullish on Disney Plus, but what about that subscriber growth guidance? Bob Chapek said he expects 230 to 260 million Disney Plus subscribers by fiscal 2024. Do you think that's still a realistic timeline, considering we have seen a slowdown across the board for these streaming companies?
Well, I think it'll be achievable. First, they also announced a price increase, and I don't think that they would have announced a price increase for the non-ad supported service if they didn't feel confident that they could reach that number. Second is they finally announced this long anticipated ad supported, more value-based priced alternative of Disney Plus as well, which will also drive revenue growth. It will also drive subscriptions because of the lower price point. And you'll probably see that, during their recent ad sale periods, they have reached record numbers when other industries or other types of advertising were talking about slowdown. So Disney's not seeing a slowdown in ad sales, and the ability to target the audiences they want through the content is a very powerful ad sales driver.
Ivan, it's Akiko here. Disney may have the content on Disney Plus, but they're facing a lot of competition over at ESPN from the likes of Amazon as well as Apple. I mean, these are two companies, by the way, who have revenue elsewhere. They don't necessarily need to be profitable on the streaming side of things. How big of a threat does that pose for ESPN?
I don't believe it's that big a threat because it will segment down to the types of sports that are available on the platforms, the fan base, and it's not a zero-sum game. We already see that people subscribe to multiple services. It's not that you pick one and you're done. That on average, people have 3 services. So I think there's room for everybody, but I still believe that the power of Disney's content will drive their dominant position.
So, Ivan, in terms of the partnerships, obviously we've seen this bundling with Hulu. What are some of the other good options for Disney to pair with to really boost growth going forward?
Well, but Hulu has a lot of the Fox content that appears it's more adult content. So I think that Hulu is also a powerful driver. And again, it's a whole nother area of content that you're not able to see on Disney Plus. But so a lot of people are opting for the bundle of all 3, Hulu, ESPN, and Disney Plus.
Ivan Feinseth, good to have you on today. Really appreciate the time. I should point out, by the way, a big pop for Disney stock in after hours on the back of these results. Our thanks to Ali Cannell as well.